Equity Market Update, December 2021. CY21 was another year of buoyant returns for Indian equities and major indices touched new all-time high during the year. Nifty 50 and Sensex delivered returns of approximately 24% and 22% respectively during the year, driven by strong growth in corporate earnings, robust recovery, surplus liquidity, low cost of capital, announcement of infrastructure plans by US, accommodative fiscal and monetary policies, etc. This was partly offset by multiple waves of COVID-19 cases across countries, concerns over China's slowdown, correction in commodity prices in the last quarter, accelerated tapering by US Fed, crackdown by China government on education and technology companies, etc. Mid-cap and small caps outperformed the large caps. All major sectors delivered positive returns, with power, metal, information technology and capital goods being the best performing sectors. Major global equity indices also ended the year with strong gains, with key indices in US and Europe outperforming Asian indices. FPIs bought net equity worth $3.8 billion in CY21 as compared to $23 billion a year before. FPIs, which bought $8.3 billion in H1 CY21, turned net sellers in H2 CY21. On the other hand, domestic equity-oriented mutual funds witnessed inflows of approximately INR 161,600 crore in CY21, vis-a-vis net outflows of approximately INR 25,300 crore during last year. Characteristics of equity markets in CY21. Broad-based equity rally in CY21. CY21 was third consecutive year of double-digit returns by Nifty 50. However, as opposed to the movement in Nifty 50 between 2018 and 2020, where the bulk of the returns were contributed by top 5 stocks, the rally in 2021 has been relatively broad-based. This is reflected in the contribution of the top 5 stocks in the returns of Nifty 50, declining in 2021. Further, the broader market has outperformed during the past 1 year, as small cap and mid cap stocks registered higher gains than larger caps. Rise in retail participation. CY21 witnessed significant increase in the participation of retail investors in equities and also rise in intraday settlement trading, although it has come off its peak in last few months. The steady increase in retail volumes is also due to sharp increase in new demat accounts over the past couple of years, as the penetration of discount brokerages increased. Historically, it has been seen that heightened non-institutional activity has been followed by moderate market returns. Narrowing of valuation divergences. The broad-based rally during the past year narrowed the valuation divergence significantly. Outlook. As on 31st December 2021, the Nifty 50 was trading near 18x FY24E price to earnings ratio. While the price to earnings multiple is relatively high compared to historical average, it can be considered reasonable in view of the low interest rate environment and healthy corporate earnings outlook. Further, India's market cap to GDP near 90% is within the historical range of 60 to 100% over the past 10 years. Further, the gap between 10Y GSEC and 1-year forward Nifty 50 earning yield remains close to its long-term average. Thus, in our view, most indicators are hinting that on overall basis, markets are near fairly valued. Going forward, we expect returns from equities over the medium to long term to be in line with overall economic growth and largely driven by growth in corporate earnings. Further, corporate earnings growth is likely to normalize from FY23 onwards after seeing a robust improvement in FY22. In view of the above, while markets hold promise over the medium to long term, it is prudent to moderate returns expectations in the near term. We remain optimistic on the economy and equity markets over the medium to long term on the back of strong global economy, easy financial conditions and low cost of capital, supportive monetary and fiscal policies, prospects of strong corporate profitability, healthy GST collections, etc. Resurgence of COVID-19 cases, spillover of China real estate issues to global markets, accelerated unwinding of fiscal and monetary stimulus by AEs, sharp increase in US yields, sharp increase in crude prices, etc. are the key risks. For more on our views on equity markets, please refer HDFC MF Yearbook 2022, published recently and available on our website www.hdfcfund.com. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.